The Senate Banking Committee's hearings on new bank regulations, the so-called Volcker Rule, continue today. But our next guest says things need to be taken much farther and that the whole banking system needs to be remade. Joining us now, Laurence Kotlikoff, economics professor at Boston University. Professor, welcome to Bloomberg News. Good to see you.
Thanks for having me.
Sir, is this a question of officials looking to treat the symptom and not the overall problem?
Right. We need to really fundamentally restructure the financial industry so that people understand what it is they're buying. We need to have disclosure. We need to have government doing the rating of the securities and verifying the collateral. And we need to run all the financial credit through the mutual fund industry, which is a safe way of running the system.
Sir, you want, and in what you were telling the Financial Times, you want a whole new banking world. That's an enormous task. Where do you start?
Well, you start with a company like Citigroup, where you say, look, take your investment banking and make it a consulting business where you're not holding any exposure. Take your broker-dealer business and engage in that, but just match buyers and sellers. Don't engage in any risk-taking yourself, and take the rest of your enterprise and run it as mutual funds, where you're now marketing mutual funds. The mutual funds really represent small little banks with 100% capital requirements. So the money comes in from the public into the mutual funds. We can buy risky mutual funds or safe ones as we choose. We're investing on an equity basis. So if they, and then the mutual fund is buying the securities for us, and we'd have a single government regulator that would determine, would verify and disclose exactly what it is that we're buying. So this is a very safe way of running the financial system. A third of our financial system is already constituted by the mutual fund industry. So I'm not talking about starting from scratch. We already have a glass that's 1/3 full.
Are we talking about here something that is doable in the short term, or is this something that you foresee is still in the stages a couple of years down the road? How quickly can something like this be turned around?
This could be turned around in a day. It's that simple, because we have a mutual fund industry. We have an Investment Company Act of 1940 that regulates the industry. We can tell Citigroup, look, from this point on, you can no longer borrow to invest in risky assets. What you can do is market mutual funds, and mutual funds have 100% capital requirements. You don't have to break yourself up into small banks. You just set up mutual funds, and they themselves are little banks. And now we're going to have a single government regulator that's going to verify and disclose and independently rate all the securities. So we'll no longer have liar mortgages or no-doc mortgages like we've had in the past. We have to get to the root of the problem here. The stock market is tanking, as you said. We still have very high unemployment. This economy is not going to be cured until people can trust the financial system. And what Mr. Volcker is proposing, although I think very highly of him and the president, is just not going to do enough. It's really trying to take us back to an older period of time. We need to have a system that's modern and really accommodates modern finance, and this would.
So, sir, are you saying that, at least in your opinion, the Volcker Rule is somewhat anachronistic?
Yeah, it's really trying to go back to the Glass-Steagall Act and say there are these good guy banks and then there are everybody else, and we're going to take care of the good guy banks and make sure they're behaving themselves, and the other guys go under. We're not going to bail them out. Well, we saw that happen. We saw what happened with Lehman Brothers, that's not really possible. There's too much interconnection given the way the current banking system is structured. So I'm talking about having something that's simple, transparent, where banks are not gambling with the public's tax dollar. It's very simple. Let people gamble. Let's keep the banks out of the gambling. Their job is just to intermediate between the public.
Sir, you touched upon it, but I wanted to ask, is what is at the heart of this is transparency? Still not enough transparency in the industry?
There's not enough transparency. We have to realize that this industry systematically manufactured and marketed something like $2 trillion worth of toxic assets. We don't know how much, whether they were all, how toxic each one was, but they went off and generated lots of fraudulent securities to the point that nobody trusts them anymore. So we need to have trust reestablished here, and it's not going to be through the rating companies who aren't trustworthy, and they've shown that. And it's not going to be through having 120 federal regulators who can't do their job. Let's have one regulator, and let's have them hire independent, non-conflicted rating companies to regulate, to rate all the securities, so the public knows that the rating companies aren't being paid off to give their advice.
Professor Kotlikoff, if I might, in our last minute, if you'll allow me just to switch gears for a minute, because one of our top stories today, New York State Attorney General Andrew Cuomo saying the state's going to sue Ken Lewis, the former CEO of Bank of America, and the chief financial officer, Joseph Price, for fraud. I was wondering if you had any thoughts on that whole thing.
I don't know the specifics of those allegations, but this entire industry is marked by fraud and malfeasance. At the top, the executives have, have engaged in lots of, I think, illegal activities and just immoral activities, left, right, and center, by not really paying attention to what has taken place here.
Larry Kotlikoff of Boston University joining us this afternoon. Professor, always good to see you. Thank you so much for your perspective. We appreciate it.